In this video, we will answer the question, can you make money on Forex? The short answer to this question is yes and no. But let's dig into the subject and try to understand what could be the answer to this question and why. But let's start with the good news first. I would like to review the article published by JP Morgan called Demystifying Currency Market Turnover. The author of the article is Frank Del Vecchio, who tries to reverse engineer the turnover data published by the Bank of International Settlements. His research is based on April 2007, when the daily average volume was 3.2 trillion US dollars. Del Vecchio says that the turnover data in Forex is overreported because there is no centralized exchange, and one trade can be reported several times. He removes swap trades from the total volume to consider only spot and forward transactions. As a result, the adjusted volume is decreased to 844 billion, and then he breaks it down further into several categories, like global security settlements, wall trade, foreign direct investments, international tourism, and hedging. And his conclusion was following. Approximately 60% of activity in the currency market can be attributed to non-profit motivated participants. This is good news for alpha seekers in the Forex market, since the majority of currency traders are not seeking to make a profit on their transactions. It is possible for speculators to earn a net positive alpha on their investments in an actively managed portfolio. Let's go further. We have found out that the majority of market participants are not profit-driven. Another important question to review: is currency trading a zero-sum game? Zero-sum game means that there is no new value created in the market, and the value and wealth is transmitted from one participant to another. Basically, a loss of one trader is a profit for another trader. In non-zero-sum games, there is always a new value and wealth created, and all participants can prosper from the game. Whether the game is zero-sum or non-zero-sum depends on the time frame and the value that is created, and how the created wealth is shared among the participants. For example, by investing into equities, you contribute to the long-term growth of the company, and that's not a zero-sum game, because a successful company generates value for shareholders over the long period of time, while in short-term trading there is no new value created, and you just compete with other traders, and it's a pure zero-sum game. In this aspect, the Forex market is not different from the stock market. If Forex trading is a zero-sum game, let's draw a parallel between Forex and a zero-sum game like casino. Casino games generally provide a predictable, long-term advantage to the casino or house, while offering the players the possibility of a large, short-term payout. Some casino games have a skill element in the game. While it's possible through a skillful play to minimize the house advantage, it's extremely rare and almost impossible to eliminate the house advantage. And the reason of the house advantage is actually zero, that gives a very small but a long-term advantage over players. So what can be the house edge in Forex? Where is the zero in Forex? Well, if you open a position, the price can go up or down, and your chances are 50-50. But there are also spreads, commissions, swaps, and price slippages. If you play zero-sum games, you can succeed if you have better skills, better technology, and better information, because you're competing against other traders. The reality of the modern market is that over the last decade, trading has evolved from trading floors into data centers, and the Wall Street now looks like this. The largest investment banks and hedge funds have the best computers, fastest connectivity, and smartest engineers, and they have their trading robots located in the data centers close to the trading venues. Do you really think that you can compete against institutional traders with your personal PC or smartphone? It's evident that you don't have enough computer power and the best connectivity. It's not an equal fight, and that's why you should avoid short-term trading. The question is, how do you beat Tiger Woods? And the answer is, you don't play him in golf. So that's why you should avoid playing short-term trading, and instead you should focus on the long-term horizon in order to be able to benefit from strong market trends. One of the most famous quotes by Benjamin Graham: "In the short run, the market is a voting machine, but in the long run, it's a waning machine." So long-term trends are important for us, but what's the reason for having long-term trends in the currency market? Why do currencies appreciate or depreciate? There can be multiple reasons for that. The number one reason is divergence in economies. The global markets are now more synchronized than before. The economic cycles are in the same stages, and we had much less trends in the Forex market than before. However, this is not a new phenomenon. It happened before, and it's likely to change in the future. Over the last few years, the Forex market was more stable, and we can expect that there's going to be more volatility in the future. The second reason is differences in interest rates, and this can create a pressure in a certain currency pair when one currency has a higher interest rate. The third reason, disbalances in supply and demand. And finally, risk aversion and sentiment. So to play long-term games, we need to have strong trends in the markets. To say it simply, trend is always your friend. That's why it's very essential to look for the trends in the market. And in this case, when we have the trends, we are able to play long-term and non-zero-sum games. We need long-term trends in the market, but we don't need long-term forecasting. The long-term forecasting is very difficult. Let's have a look at the predictions of several banks at the end of 2004. The predictions were given for the first half of 2005. The average forecast was 1.28, and the maximum forecast was 1.38. And only one bank predicted that the US dollar will reach 1.20. Actually, there was a broad weakness of the US dollar at that time, and most of the banks were predicting further depreciation of the buck. However, the situation changed dramatically. The Fed started a tightening cycle, and the dollar made a U-turn and reached 1.20 in 6 months, and appreciated further till 1.18 till the end of the year. So as you can see, even the largest banks make mistakes in their long-term forecasts. There are too many factors influencing the markets, and that makes long-term predictions very difficult. So the sweet point of forecasting is somewhere in the middle. Here I try to demonstrate this idea. It's a very simple presentation. Short-term trading is a zero-sum game, too much competition, low probability to have an edge over others. Long-term trading is difficult either because there are too many inputs, too many factors influencing the market. At the same time, to trade long-term with a lower leverage, you need more funds and more time. The sweet point is somewhere in the middle, where the market is more predictable. I think that trading Forex is like the famous Marshmallow Test. If you have never heard about this test, I recommend checking it on Wikipedia. In this study, a child was offered a choice between one small reward provided immediately or two small rewards if they waited for a short period, approximately 15 minutes, during which the tester left the room and then returned. In follow-up studies, the researchers found that the children who were able to wait longer for the preferred rewards tended to have better life outcomes. Trading has never been easy as before. Just with a few clicks, you can open a brokerage account and start trading. The platform is blinking all the time. The markets are volatile. We are always tempted to click buy and sell buttons. The most challenging part of the trading is actually not to trade, or trade as little as possible. Wait for the best opportunities and follow your trading plan. Patience can actually be your competitive advantage over institutional traders. Some institutional traders are obliged to have a position in the market and generate trades, but you don't. And self-control and following your trading plan can be your advantage over other traders, because the trading is very emotional. We would like to finish this video with a quote of Jesse Livermore. "It was never my thinking that made the big money for me. It always was sitting." Here is a quick summary of this video. Avoid zero-sum games. Trend is your friend. Don't trade too frequently. And be patient and follow your plan. I hope you found this video useful for your future trading. Thank you for watching.